What's good, everybody? Mo Kama's Sunday service. Today, we're going to be talking about whether we are still in a bull market or not. I wanted to do something a little bit different this time. I probably am going to go into swing trading first and what I'm looking at for next week, just because with all of this tariff talk and them going on and then going off, like the market's been going back and forth, right? And just like, who am I? I'm an attorney. I trade in my spare time, if any, right? Mostly swing trading. I don't day trade as much anymore. Got a couple $100,000 in the market in my long-term portfolio and in my swing trading account. And this is a channel primarily where we look at the market every week, and I kind of tell everybody what I'm looking at and what I'm doing, right? So I'm going to go into my swing trading because I think this directly relates to our general topic of, are we still in a bull market? For me, I'm trying to figure out where the tide is going. Are we going up? Are we going down? And whether we're in a bull or a bear market is going to determine how I trade, right? If we're in a bear market, I'm going to be doing more puts. I'm going to be selling more call spreads, right? If we are in a bull market, I'm going to be buying more calls and I'm going to be selling more put spreads, right? Just because I want to be in the general direction of where the ocean is taking us. As a disclaimer, what I always say, this is for informational purposes only. This is not investing advice. I am not an investing professional or financial advisor. Direct your trades, investments to your licensed professionals, and ideally, you do your own research, and this channel will help you do that in the future, right? So, what's my watch list for next week? My swing trading has been doing well. Once again, knock on wood. I went 1 for 1 again last week, so I'm like 5 for 6 on the year. And it's mostly because I've been taking the most trending sectors. Even my trade last week was on Abbott Labs, which I discussed last week. It pulled back heavily. I got in, scaled out 25%, like literally within an hour or two. And then it came right back on me, and then I got out for break even on the rest of my position, but made about 150 bucks. Nothing to write home about, but a win is a win. And it just shows me that I've been looking in the right area. So if you've noticed over the last couple of weeks, and then going back to the beginning of the year, you saw most of these sectors. This is koifin.com. I go to the US sectors tab, right? And then I click on the check. I check off the industries that make up the key components of the Dow, the Nasdaq, and the S&P, and even the Russell. I have KRE in there. So essentially, I'm looking at the sectors every single week, trying to figure out where the money is going. Where is the money flowing? And is money flowing out of a particular sector, right? So once again, if you look at the last 30 days, you got consumer staples and you got healthcare and gold are the only things that are positive, right? And what does that tell me? This is the safety sector of the market. Uh, Anytime gold is up, healthcare is up, and consumer staples, the boring stuff, that means people are a little bit scared with their money, trying to figure out, hey, maybe I should rotate my money, especially the bigger players, into sectors that don't have a ton of volatility, right? Coca-Cola doesn't generally have a ton of volatility. Pepsi doesn't have a ton of volatility. Walmart, Costco, Procter and Gamble, these aren't sexy. These aren't the names that are always being talked about on CNBC. These aren't tech giants. So like that's safety, right? Colgate, candy, like things of that nature, right? Things that are going to be around even in a recession, that are probably, people are still going to need to buy toothpaste during a recession. People are still going to be buying Coca-Cola and Pepsi soft drinks, and there are a billion sub brands underneath them, even in a recession, right? And I don't necessarily know that we're going into a recession right now. It's just that our current political environment, I feel like they don't, and I've said this a long time, I don't think they have a North Star. So tariffs are on. And then the president gets a call from the car companies and they say, hey, the prices of our cars are going to go up dramatically if you put on these tariffs. And then he pauses them again. Tariffs are on, and then he talks to Canada or Mexico again, and then he pauses them again. So the market is kind of like in this flux where no one knows or has any certainty as to what's going to happen going forward. This has also been with things like TikTok and just all of these other things that are kind of like in flux. Like you want to deport more people, but you're firing people. So how are you going to deport more people if you have less employees? So it's just like some of these things that are like oxymorons, right? You don't want a big federal government, but you want immigration numbers to go down faster, which requires hiring more people to make sure that happens. But you have like these competing concerns, and I assume over the next few months we're going to see what happens. There's going to be some solution or some clear path. And I just don't believe as a country we should be fighting a three front war. If you're gonna tax China, and then we'll worry about Canada and Mexico later. If Mexico's the biggest concern, worry about Mexico and then tax China and Canada later, right? Why are you opening up this three front war economically when the stock market has been showing you what people think about that, right? So that's what's been happening recently. If I could say, like, why have we gone into a correction, a 10% drop in the market? And it's mostly been due to this tariff talk. Like that's really the only thing I can really point to. There's been some other economic news as well, but Nvidia reported really good earnings. Broadcom recently reported really good earnings. So it's not really the earnings reports, it's whatever the hell the government is doing right now. And I think the problem is it's just that no one knows. We just want to go in one direction or the other, but like no one knows what's happening. So people are a little bit scared with their money. So from what I'm doing next week, same thing that I've been talking about the last couple of weeks. Consumer staples, if you're going upside on anything, that's the strongest sector right now. Healthcare has been leading, or I wouldn't say leading after consumer staples. It's not up that much, but I've had some decent trades on Johnson & Johnson and Abbott Labs the last couple of weeks that have made me some money. Not a ton of money because you see like the sector hasn't ran, but on these pullbacks, like on this day right here, I believe that's the day that I got in, and I think I got in on this day as well. On J&J, I think this was my Abbott Labs day right there, right? So just on some of these pullbacks, it seems like these are the two strongest names or strongest sectors in terms of consumer staples, healthcare, right? And so another thing I wanted to show you, right, if you don't have a setup like I have on my Thinkorswim, how do you know what's in XLP? It's simple. You could just type in XLP holdings into your search bar. Go find sector SPDR spiders, is what people call them, right? And then it'll tell you what the weighting is in that particular sector, right? So what are the top names in XLP? Costco, one of my favorite names that I own in my long-term portfolio. That's the most heavily weighted. It's almost 10% of the index, right? Procter and Gamble, Walmart, Coca-Cola, Philip Morris, Pepsi's, Mondelez, Altria, Colgate, and Target, right? And you can go even further in, but I usually try to focus on most of the most heavily weighted names. So I generally am going to trade like the top 8 or 10 names, right, in that particular sector. This is also a good investment lesson too, right? This is a sector ETF, and they are essentially telling you what they believe are the best names in that sector. So if you're looking in your long-term portfolio at what should I buy in the consumer staple, I want a safety name, I want something safer. Like they're telling you what they think is the best name. Like, right, this is how they're weighting their sector. So they love Costco, Procter and Gamble, and Walmart. Right, those are their top three. And as you see, that those are the names that I've been telling you about. Like I own Costco, and I've been trying to get into Walmart for a long time now, right? Not so much Procter and Gamble for me, but if you're talking about what these big hedge funds and uh, big funds think about a particular sector, this is how they are constructing their portfolio. If you were to try to do the same, right? So that's XLP. If you want to XLV, which is the healthcare sector, always type in XLV Holdings, same thing, sector spiders, go to the holdings, and look, the same names that I've been telling you guys about: Eli Lilly, UNH, which are the top of my list to hold in my long-term portfolio. I missed out on Eli Lilly, and I've been telling you guys about UNH over the last few weeks. Then you got J&J, AbbVie, Merck, Abbott Labs, TMO, Thermo Fisher, Intuitive Surgical Care, Amgen, and Pfizer, right? And if you're looking at the weightings, Eli Lilly is the heaviest weighted. UNH is after that, Johnson & Johnson, right? And that's where I've been looking. So over this next week, if I'm taking anything to the upside, it's going to be one of these names, or it's going to be one of these names, because these sectors are currently trending, right? And so when I'm talking about right now, our main topic is, are we in a bull market or a bear market? That may change my directional heading for my swing trading. If I think we're heading into a bear market, instead of focusing on upside as much, maybe I might just focus on consumer staples, and I go look at what's really negative and start shorting more. Right. And so what's the most negative? KRE inside of the Russell, the regional banks. XLY, consumer discretionary, primarily made up of Tesla and Amazon. If you guys would have shorted last week at $300, where I told you to, you would have made a lot of money on Tesla. I was preparing for a trial, so I didn't catch it. But it literally popped up to like 304, 305, and then headed straight down. I think it's at like 260 or something now, right? So Tesla has been looking bad. Amazon, I'll go look at Amazon, and then even semis in general. And this is crazy to me because Nvidia's earnings were good, AVGO's earnings are good. Those are the top two names usually. Hold on, let me just. TSM is usually top 1, 2, 3. If we go to, where's SMH? Where's their holdings? Here it is. Nvidia, top name in SMH. TSM, AVGO, top 3. ASML right behind it, right? So these names, I haven't looked at TSM's earnings as much recently, but or I don't recall. Nvidia, AVGO, they reported like great earnings, and so the sector is coming down, but the earnings have been good, which is why I conclude that it has nothing to do with the companies themselves, but just the general atmosphere of these tariffs that are coming on and off every other week that are pushing tech down. But in terms of the worst names right now, that's where I'd be looking, as KRE, consumer discretionary, semis, and even metals and mining has been low, but those may be the four. And if we are heading into a bear market, I'm going to focus more on the negative side, meaning pops to the upside on these names to short back down, rather than looking for pullbacks on the best names that are positive right now, which is consumer discretionary and healthcare, right? So, y'all following me?
Yes, sir. Yeah.
All right. So, looking at the general market, this is the Nasdaq. I'm on a 5-year, 1-day chart. Looking at the Nasdaq specifically, it still looks like we are in an uptrend. We are just in a correction point of this uptrend. What I don't like, though, is that it didn't hold, or it looks like it could still be holding because we're still close here to this 200-day moving average. Anything that starts going below a 200-day moving average, I start to get a little bit worried, right? Just about the general market. The NASDAQ 100, and we're looking at the futures just because I think it's the most accurate because it's open the most hours, usually like 23 hours a day, the futures are open. So, like looking at the Nasdaq futures, this 200-day moving average right here, we came below it. We are popping back up to it. We'll see if we can hold this and keep going back up. I would say there's a good chance we stay in the bull market. But what I don't like is all of these lower period moving averages crossing over the greater periods, right? My green is a 21 day, my orange is a 34 day, my blue is a 50 day, and my yellow is a 200 day. If you're starting to see the trend start reversing, especially if we start seeing this 50, the blue, come across this 200, which is called the, what is it, the death cross. It's almost a lagging signal, a lagging indicator that we're starting to go into a bear market. If I start seeing this 50 get closer to this 200, then I'm really going to start thinking we're going potentially into a bear market. This is specifically for the NASDAQ. For the S&P 500, which is the overall stock market, same thing. We are still making higher highs, and we still haven't really made a lower low, maybe except for this low right here. If I see this trend continue, same thing. We're right around this 200-day moving average, but we're just above it. We're starting to see some of the lower period moving averages cross. But if I start seeing this 50 get closer to 200, that's when I'm going to think we're heading into a more of a bear market, and this just isn't a correction, but more of a longer term trend of where we're going. And if that's the case, I'm going to be more on the short side of the market versus the long side. And another reason, and this is kind of come into play recently for me, I think why I am still swing trading rather than just long-term investing is because me making these few $100 throughout the week kind of cushions my long term. If there's some drops in the long term that I want to hold for 5 years, me being able to make some money in the short term on drops or pops in sector rotation helps brace for some of the losses, right? Even like because I'm heavily invested in the semiconductor sector, but looking at the charts and the sectors, I might be shorting semis next week. So while I might be losing on the downside in my long term, I could be making some money in the short term just shorting something that looks technically good to short right now. And I'm not really going to try and rotate or sell anything in my long term account because my strategy there is different. It's hold for as long as I can, because most of these names are fundamentally sound and have been reporting decent earnings, so I expect them to go up in the long term. But right now, hopefully all of this is just noise over the next few months, the next year or so, and then we start seeing the more consistent growth in the stock market that we usually see, right? So that's the S&P 500. The Dow, same thing, right? It's getting close to that 200-day moving average. You're starting to see some of the lower period moving averages cross over, which isn't good for short-term trading. You usually want to see the lower periods like this on top of each other, right? Of the longer periods, which is a positive trending environment. But looking at the Dow, it's the same thing. We're coming down to this 200. We made this correction, and it popped up off of that 200, and it's right now, recently, it's heading back up. But we'll see over the next week if it can sustain this momentum back to the upside. And the last engine, the Russell, the small caps. What are the small caps doing? They look the worst, right? This is KRE, which is a portion of the Russell 2000. These are like some of the smallest publicly traded companies, the small caps that are inside of the Russell primarily, and these are like equally weighted versus like what we've seen in some of the other sectors and indexes where it might be heavily weighted tech or this or that in terms of sectors. The Russell, almost all of the 2000 stocks, especially once it re-weights everything, they're going to be equally weighted amongst those 2000 names rather than like this sector or this name being 10% of the Russell, right? At least as of today. Looking at the Russell, this looks like the worst engine in the stock market right now. Um, this was, it looks like I drew these levels a while back from here to here where it looked like it was kind of trading sideways. And now we see it drop. Look at that 200 moving average. Look at the 50. This is the by far the closest we've seen the 50 getting to the 200. So the Russell doesn't look good. In fact, looking at this, I think this is probably going to be at the top of my list to short next week. Is going to be the Russell through what's the ETF for the Russell? How do I wait? How do I usually short the Russell? What's the ETF equivalent? I don't know why I'm blanking on this. I know KRE looks bad. This is a portion of the Russell. Same thing. This is going to be the top of my list to short next week. And then why can't I remember what's the Russell ETF equivalent? Hold on. Because I don't short it all. Russell 2000 ETFs. IWM. I'm tripping. Yes. IWM is the ETF equivalent for the Russell. So let's go back. So IWM looks just as bad as the Russell because it's essentially the ETF equivalent. So I'll look at the futures to just look at the general price action because it's going to be more accurate than the ETF of the Russell. But IWM looks just like the Russell because it's essentially an equivalent of it. So I don't like this price action at all on the Russell. So I would look to really short this next week. I'm really thinking I think this might be the top of my list. I'm just gonna look at it from my other chart. Yeah, it's trending negative. And the chart looks really bad right now. So to answer my question, are we in a bear market? I don't think we're fully in a bear market yet. The only major index that is trending really negatively is the Russell. But if you look at the S&P 500, it's holding at that 200, and we're not quite there yet. We're like in limbo. If you look at the Dow, same thing. It's holding at that 200-day moving average, and we're kind of in limbo. We're not quite there yet. And the NASDAQ, big tech, we're there. We're a little negative, but we're not quite there yet to say that we're in a bear market. But I think I'm going to be more balanced over the next week or two in terms of going long and shorting, right? I think I'm going to be trying to take XLP names to the upside. And I think I'm going to be taking some tech names, some semis, and the Russell 2000 through IWM or KRE to the downside. Right? And if we go, where are we? Let me go to my flexible grid. Look at SMH, right? When I was looking at this last week, because I was looking to potentially short TSM, NVIDIA isn't really negative. It's kind of neutral. TSM is more negative. AVGO. The reason why I don't think I'm going to short AVGO and NVIDIA because their earnings were really good. I don't want to short really strong names, even though the market's going down. I want to go find the weakest. AMD, even though I have leaps on that, have been really weak, but I also think it's really exhausted. So my main targets for next week to short if I'm in SMH, would be TSM, which is more of a negative trend than some of these other names. It would be TSM, AMD, which would be an opportunity at where I purchased it. I think around 110 or around, what's this price right here? Around 106. At least this is for Monday, depending on what the price action looks. I might short it to come back down to where it is. And then I also look at that too. It's like if I make some money on something that I own coming down, it's almost like I bought in for a cheaper price, right? So I'm looking at AMD looks the weakest, but once again, I'm kind of trading against myself because this is in my long term portfolio. TSM looks weak. I even like just the entire sector. I probably would short SMH, the entire sector, maybe over one of these individual names. AMAT looks pretty bad too, but I don't trade this often, so I don't know what the liquidity looks like. But AMD liquidity is usually pretty good. SMH liquidity is usually pretty good. TSM liquidity is usually pretty good. Those are the ones that I'm really looking to short. AVGO doesn't look that great, but once again, its earnings were good. So I'm not shorting something with great earnings. I want to try and take the weakest in the sector. I would probably be more comfortable taking the entire sector down rather than these individual names that could do some different things. But just seeing, other than Texas Instruments, most of the sector is red, at least in a momentum standpoint. Like, so from a short standpoint, I'm looking at SMH. It's also almost like a hedge for my long-term portfolio too. If one of these names pops, I take it to the downside. So if my portfolio is going down, I'm making some money on the way down to kind of brace myself for some of these losses if we start really heading into a bear market. That's SMH. Let's look at XLK because Tech, I don't think, was doing that well. No, actually, Tech isn't. It's not great. It doesn't look great. Microsoft looks the worst, but it got some neutral trends and some green trends like on Cisco. So Tech in general, I think it's more of like the semis that aren't doing that great right now. CRM doesn't look good. CRM looks good for a decent short, right? But I think what's been working for me recently is staying with like the worst names in the sector. So the top two worst sectors have been semis. So I'm probably going to stay there and the Russell and the KRE. So those are going to be my top two areas where I'm trying to short next week. And let's look at XLP and XLV where I might try to take something to the long side, but I'm more biased to take. And see, this is what I'm talking about. When everyone says the whole market is going down, not consumer staples. If you were in consumer staples the last couple of weeks, you'd have made you some good money in almost any of these names, right? And it's because the people with a lot of money have been rotating their money into these names. They haven't just been selling and then holding cash underneath their mattress. Look at this sector. This whole sector is up with the exception of Target and Walmart, but even Walmart doesn't look that bad. This whole sector is up. So I've been trying to get into Coke, haven't been able to get into it, and it's kind of leveled out. But look at Procter and Gamble is starting to look better. So I might look at Procter and Gamble next week. XLP itself, I would look at. I'm just looking at these names, Mondelez that we just talked about, to see if it has liquidity, because sometimes with these names that aren't so well known, it's hard to find liquidity. And actually no, there's liquidity in the options there too. So I would potentially put that on the list for next week because it looks good from a trending standpoint. Let's go back to the chart. XLP itself, I would still keep Coke on that list because it's been holding right there at that price. Didn't quite hit my alert to get in, but it's been holding at that price. Procter and Gamble and Mondelez for next week. I don't even know what Mondelez does, but I know it's a consumer staple and it's heavily weighted. And look at Colgate. Colgate might look good too for next week. Let me see what the liquidity looks like. And then if I start seeing liquidity on some of these names, that tells me it's because more people are rotating into it, which is good. I don't see as much on Colgate. I would like these 95s right here, but it's only 700 open interest. Can't sell a spread on it. So Colgate's off my list because there's not much liquidity, but Procter and Gamble, Coca-Cola, XLP itself, and Mondelez are going to be on my list for XLP. Last one I want to look at is XLV. XLV actually looks good too. Look at the trend, right? It's been breaking highs in a market that's been going down. It's been coming up, right? J&J, I had a good trade on that last year, or not last year, last week or the week before last. J&J still looks good for a pullback. I like Lilly, but Lilly's options are really expensive, so it's harder for me to trade Lilly from a practical standpoint based upon how I trade, unless you have a bigger account size. If you have a bigger account size, go ahead with your bad self and trade Lilly, because Lilly has been trending pretty positively too. Had a slight pullback, but this would have probably been a good day to get in. Would have been Friday. But yeah, XLV itself, J&J, AbbVie looks strong. I would love to get into AbbVie. Look at that consistent candle movement up on a pullback. That looks really strong. And so just look at like what the market's been doing. Everybody's been talking about how the market's been going down, but look at this strength in certain name. Amgen, look at that. And look at Abbott. I told you I had a trade on this that I made some money on last week. Abbott Labs looks good, but I'm looking at I really like how AbbVie looks. I've traded this before, J&J and Amgen, just to go show you my process. And we'll look at XLV itself too. March 21st, this is OPEX date. That's where I tend to find the most liquidity is during OPEX. Ton of liquidity there, but look at the spread. The spread looks terrible between, and so I use spreads interchangeably. Like there's two definitions. I could sell a spread, or what's the spread between the bid and the ask, right? And that tells me how much volatility there is in these options, because like ideally I want to buy at the bid and sell at the ask, but I usually like to trade things where there's not that much of a difference between the two, because it's going to be hard to get in and out of this stock if there's this much of a difference. This might be just because we're in the weekend and the market isn't open, so I would check this during the week, but I don't like the massive difference between the bid and the ask. But if this were closer, XLV itself would be on my list. What did I say? AbbVie. Look at the options on AbbVie. There's tons of liquidity here. They're a little expensive, but look, the difference between the bid and the ask aren't as great when you're looking at the option price. And once the market opens, I assume the gap is going to close even more. So AbbVie would be on the list. The options are a little expensive, but I do like this and like how this looks right now. I can't really sell spreads on it. Maybe if we come down a little bit and I can get in at the 207.5 and 202 levels, I could potentially sell a put spread on this to the upside. So yeah, I like AbbVie next week. It's on my list. What did I say? J&J. J&J is usually liquid. Yep, J&J is mad liquid. So J&J would be easier to trade. You might even be able to do a call spread on J&J at this 165 and 160 level. So J&J is on my list. And then what was the other name? So we had J&J, AbbVie, Abbott. Oh, Amgen. Let me go check Amgen. I don't usually trade Amgen much, but I've been hearing a lot about it just from people talking about it in their long-term portfolio on a couple of podcasts that I listen to. They're really expensive. Amgen is the options are really expensive. No, so Amgen is probably off my list just because the options are really expensive. There will be no way for me to scale into this the way that I like to trade. But once again, if you got a bigger account size, go ahead with your bad self. Amgen is liquid, but the options is just too expensive, similar to Lilly. And I just want to show you why I don't swing trade Lilly. I want to buy it because if I were to buy Lilly where it's somewhat liquid, look, the options are $3,000, right? So I try to trade options that are like $1 to $5, not $3,000, right? So The only way I would be able to trade something like this is on a spread, and if there's no liquidity there, even if Lilly is doing really well or Amgen is doing really well, they're too expensive for my budget and my current swing trading account, so I don't trade it. So Amgen's off the list for that reason for me. Um, so next week, J&J, AbbVie, and I might take a look at Abbott Labs again. I don't like XLV. I didn't like the liquidity there or the difference between the spread between the bid and the ask. So I might not trade XLV itself either, unless that's just a weekend glitch on the platform because the market's not open. Right. So that's what I'm looking at next week. Unless you guys want to look at any specific names, I don't necessarily think that we are in a bear market yet. The Russell is closer than the other three engines of the stock market. When I'm talking about the engines, it's the Dow, it's the NASDAQ, it's the S&P 500, and the Russell. Right now, one of those engines is close to being in the bear market, but the other three are kind of straddling the fence. So I'm kind of playing both sides of the market right now, to the upside and the downside, until we get some clear direction as to whether or not we're going to be going up, down, or sideways for a prolonged period. So that's my answer, my long-winded answer to the question of whether we are still in a bull market or not. All right. Anybody want to look at anything? A name that you're... what I do want to do, last thing I want to show y'all is Tesla. Look at this thing. All right? We talked... This was the Friday candle. We had our class over the weekend. What did I say? At 300, I would look to potentially short Tesla. What happened? It came up the next day to 300 and hasn't looked back since. Popped right back down. So if you would have listened to me, you would have made a lot of money. The technicals were awesome. The only reason I thought there would be a ton of resistance is because I've been charting Tesla for a long time, and that 300 to that 150 level had been the range of Tesla for so long, and then we got this post-election pop because Elon is the new czar, and then he starts doing the Nazi salutes and stuff, and we haven't come back from there. And then they're boycotting him. Tesla sales are down. So if they don't get those robots online soon, I just don't like where Tesla's heading. And I would be shorting this on pops, especially because XLY, the consumer discretionary sector, has been down. Tesla is one of the most heavily weighted in there. And I just don't see people buying more Teslas anytime soon. Right? So if it gets close, if it keeps on these pops, and then I think I had another one last week because I was prepping for a trial that ended up settling, which pissed me off. Like if I'd have settled that thing earlier, I could have potentially had this short all the way down on Tesla. Because I was looking at it. It came above, just slightly above 300 to like 303, 304, and then never looked back. All right, anything y'all want to look at?
I'm good this time, thanks.
Yeah. All right, hear nothing else. That's it. We're going to end a little early today. Mokama Sunday service, making it rain without the umbrellas, trying to look at the market every single week, trying to understand it a little bit better, 8 a.m. every Sunday. And for me, like I thank y'all for this because I've been on my game a little bit more because this forces me to do my homework every week instead of coming into Monday or Tuesday when the market opens, trying to do this Monday morning. Doing this on Sunday morning helps because now I already know where I'm looking. I'm going to go on Monday morning. I'm going to use my tools that I've bought from Simpler Trading, which is part of this grid. All of those names that I just gave you, like XLP, on Monday around 8:40 or not 8:45, but 6:45 in the morning, 15 minutes after the market opens, I'm going to come in and start setting my levels and my alerts on all of the names that I just gave you, and I'm waiting for one of them to trigger. When they trigger, I hop in. And that's pretty much been my strategy. But this Sunday, it's telling me, hey, I've looked at the market. I know where the market is heading. or not heading, and here are the places that I'm looking. So if something ends up panning out, I just get an alert on my phone, and then I just go hop into the trade. Right? So trying to just give y'all what I'm looking at every single day, every single week, and doing this on the weekend before something triggers, just having your plan ready. Like I even know now, looking at the liquidity in a lot of these names, which ones I'm going to be able to sell a spread on, or which ones I have to buy calls or buy puts on, because I've already looked at where the liquidity is, and so I kind of get a sense of what my budget's going to be. Any names that I can sell a spread on, my budget's usually 14 to 1500 bucks. If I'm buying or buying calls or buying puts, my budget is $1,000 because that's a little bit more of a risky trade because time decay is not on my side, so I take a lower budget for that. But I already know that ahead of time, so when these things trigger, I'm not thinking as much. I'm just executing. So, just some advice, especially for this year: don't think as much, execute. All right, folks. Till next time.
Appreciate you.
All right.
Appreciate you, my guy.
Yes.